now tuned into the Money Level Show.
But still, I mean, if we ever get back to something like a 2% portfolio allocation to gold, there's just the asset class is so small, the price would have to go up so much, and it's really nuts. And I have half a macro piece that I've typed out and put away and typed out and put away, and it just doesn't come out. It's either
Mm.
too long or it doesn't come out the way I want it to. But it's all about Carl Menger's origins in the history of money, and why gold is the place to be when you have the US and China as a peer rival, because money is a network. People want it because other people want it. And when I was a teacher, I would ask the class, what's money in prison? And they would all say cigarettes, and I would say that's incorrect. The US prison system went non-smoking about 30 years ago. But everybody knows what I mean. Like, if you were in prison and your mom is like, well, what can I send you? And you'd say, send cigarettes. She'd be like, well, you don't smoke. It's like, it doesn't matter if I don't smoke. I can use cigarettes. I can get a haircut. I can get what I need. Right. So it become, even if you don't use it, it's the thing that everybody wants. And they want it because everybody wants it.
Yep,
But
exactly.
if the US and China carve up the world between them, then the US dollar or the Chinese renminbi, that can't be the thing that everybody wants, because everybody wants it because half the world won't want it, because half the world is going to have this thing looking over their shoulder like, how dare you use that thing? So that makes gold the best money in a world where, what can win to be that network? And it's still
Mm.
early. It's still something like 12% of central bank reserves, and it's going higher because the central banks are still buying. So I keep
Yeah.
feeling like the chart looks like it should pull back, but it just hasn't. And maybe it won't. Maybe it's just going to keep on going up. I don't know. Maybe it
hmm
goes up for 10 years. Maybe it's the place to be.
Yeah. Yeah, it's definitely a neutral reserve asset. Um, and yeah, I've been thinking, I was talking with Doomberg recently, and they did have that Fed article come out about potential like gold revaluation. And because right now it's sitting on the United States books at freaking what, $42.
Yeah.
And it's like, yeah, like if they were to do that, that'd be insane. Even if they revalued it to where it's at today, like, I mean, that could be a huge surplus of cash, you
I
know?
think that only gives like 6 months worth of expenses to the treasury. It's not like a huge windfall. I mean,
Yeah.
it's people talk about it a lot, but I think they'll spend it pretty fast.
Yeah, joint
Um,
it's gone quick.
yeah. But I had a post. So after July's data came out, it's a little worse because July the deficit was worse than last year. But 4 months in a row, the deficit was better than last year by, it's now $192 billion. So
hmm
last year, the deficit was 1.8 trillion. So we're on track to do a little bit better this year.
Yeah.
I mean, it's still a lot,
Yeah, yeah.
but nobody's giving credit to Trump for it being better because Congress's fiscal year ends in October. So when people say the 2025 deficit, it has November, December, and January in it. And that's the time period when what's his name? He started Project Veritas. He was interviewing some Democratic apparatchiks, and they were saying, "Oh, we're throwing gold bars off the Titanic." So, like, you're going to lump in the 3 months where they were spending every dollar they could get their hand on to try and shovel it out to their, NGOs and stuff, and say, "Oh,
hmm
but the deficit in 2025 right now is worse than 2024." But if you look at February, March, April, May, June, and July, 192 billion better than the year previously, and nobody's talking about it. It's a forbidden topic because, and if you even ask Google, if you just
hmm
ask Google what was it in June, the Google's AI will be like, "Oh, well, the full year 2025 is worse than 2024." I'm like, that's not what I fucking asked you. You're
Yeah,
pushing some
yes.
political bullshit on me now, Google, because oh, I hate that when Google gets political, and they do it all the time. I mean, these companies, I don't know how they aren't busted up for their partisan hackery, because
Yeah.
and the government has them by the balls because you need to be incorporated. You need the government's permission to survive. They could just,
hmm
strip their corporate personhood away and, treat them as criminals and fine them, and they could force the breakup. The governments can do all that stuff. So
Yeah.
I wonder
Yeah.
if how much because
Let's
Trump
let's get let's
has
get recorded,
oh
man. We got a lot
yeah.
to talk about.
Okay.
All
Oh,
right.
Do you want to talk about Opendoor?
I'm already. Oh, damn, I forgot I'm already recording.
Oh, it's all
Okay.
good.
Yeah, yeah. I got it on automatic because sometimes I forget and I'm just like, oh shit, I didn't even record the episode till like halfway in.
It's all good.
So
And you know
yeah.
what? You can, if you want to add it to the episode, you can put in everything we just talked about. It's fine. But
Okay.
have you been following Opendoor at all?
Yeah, that was the meme, the one that you had put out a while ago, and then it turned into a meme, right?
Well, it's uh so they're calling it a meme, but I think that's fair. So if you look at GameStop had this massive short squeeze, and it was the first time that the retail investor coordinated heavily. And then, Reddit started blocking anybody that mentioned GameStop, so they have to go off network now to network for that stuff. But it was also a big deal about how with this options heavy market, if you buy all these call options, the hedging books of the dealers, they have to buy the stock and it pushes the stock up. So there was a lot of things going on with GameStop. But if you look at their market position, Steam owns gaming right now. Like Steam is the network sitting in front of the network. But Carvana is different. Carvana has a chance to take, 10, 15, 20% market share for all used cars in the country because,
Mhm.
they figured out going to a car dealer sucks. It's awful. The other person knows more than you. You have to sit there all day while some dude fills out paperwork and tries to upsell you on a warranty or some film on the glass or whatever, and you're just trying to not spend an extra $2,000. Like, it's just an awful experience, and you feel bad, and you always feel bad about it. And Carvana said, well, if we could make it fun and a kind of painless experience, and they're taking enormous market share. And there was this time when the whole market thought that they were going bankrupt, and they weren't. And it went
Mhm.
from $300 to $4 to $300 again. Like it's a huge, but their market position is incredible because they could, if it's a network good, it becomes this winner take all market, and they have the ability that if they won, they would sit in the middle of that network, just like Uber. There's also Lyft, but there's kind of like winner take most, and maybe like a second place can kind of hang around for a while.
Mhm.
So Carvana is there. GameStop is not really. It's hard to do that when you have Steam, right? GameStop is kind of like the also ran second place compared to Steam, but Opendoor has a chance to be the market winner, the network sitting in the middle of the network for housing. And housing is this enormous asset class that does $2 trillion of revenue a year. And people don't even think of it. It's enormous, but it doesn't show up in GDP because the houses are finished goods from years before. So it's a $2 trillion market that doesn't show up in GDP. It's this bizarre thing, but it is huge. It's massive. If you took 10% market share of that market, that's a several $100 billion company. And what's really crazy about it is, so Zillow had started doing it, Redfin had started doing it, and there's another company, OfferPad, which is much smaller than Opendoor. But there's this structural problem in housing, and we have academic. So once upon a time, I was a professor, so I just too much academic garbage in my head. But the paper is by a guy named Akerlof in The Market for Lemons. It's about information asymmetry, and the idea is so you know, Opendoor can have all this information about your square footage and your number of bedrooms and how many miles you are to a good school and the quality of the schools in the area. But there's some things about a house that's just, it's just nice in a qualitative way that you can't really capture. Like, does it have a linen closet, or is the layout nice, or does it have curb appeal? That
Mhm.
stuff is very hard. And the seller of the house to Opendoor, they have that personal knowledge, and Opendoor is going to be the patsy at the poker table who doesn't know. So when house prices fell with rising interest rates, Zillow lost, it was almost $1 billion. It's something like $900
Yeah, I
million
saw
because,
that. What were they buying investment properties or something like that? And they
yeah,
lost.
so they were house flipping. They were house flipping, and they got confronted with this lemon problem that the sellers know if the house is trash or not, and Zillow doesn't know. And as long as house prices were rising, it kind of didn't matter because if it's on your inventory for 6 months, you make so much money anyway. But when house prices were falling, Zillow lost $1 billion, and that's not like pocket change. So Zillow got out of the market. They said, we're shut down this department. We are leaving. This is not happening. So Zillow not only left the market, Then they signed a partnership with Opendoor. I think they took some shares or some warrants or something. And now on Zillow, if Opendoor operates in your area, you can just click a button and sell your house to Opendoor on Zillow. So you took the leading competitor to Opendoor, and now they're a marketing channel. So, and Redfin, same thing. They exited the market. They didn't lose as much. Opendoor lost $1 billion doing it too. But they know the problem is adverse selection, or they know the problem is that information asymmetry, where the seller knows more than the buyer. So they're trying to figure out, okay, can we use AI to see if we can estimate curb appeal? Can we take some drones with LiDAR and map out the floor plan and use AI to figure out if this is a good layout or a bad layout? So they're going to try and overcome this information asymmetry over time, and they have a 10-year head start. So the odds that this company could be, the center of this $2 trillion annual marketplace is pretty good, because nobody's fighting over it with them except for OfferPad, and they have the same problems and they're just smaller. So now that we have visibility on rate cuts, the timing is, and I thought I was early. I thought rate cuts were coming. I didn't think Jerome Powell would hold out so long on keeping rates high. They're not even high by historical standards, but he's still quantitative tightening, which is rolling off the mortgage-backed securities in the balance sheet. So even though I don't feel like interest rates are that high for most corporations to borrow money, with quantitative tightening focusing on mortgage-backed securities, it's still crushing the housing market. And the housing market has this problem that when interest rates were zero, we built houses that were like 1,000 or 500 square feet too big there's no starter homes. And that's a structural
Did
problem.
they reduce that significantly though? I was hearing that they may have reduced it. I think for a while it was like in the tens of billions, and then now it's like at what, 5 billion or something like that.
Which number are you talking about?
The quantitative tightening, like how much they're selling
Oh,
off.
yeah. So that they're rolling off less, but they're still rolling stuff off the balance sheet, which I'm not even against, because there is some slack in the financial system, but they're focusing on mortgage-backed securities, which it was illegal for the Fed to buy it in the first place. They had to go to BlackRock and create some special vehicle just to break the law, and nobody cared because they thought it was necessary at the time. So, they shouldn't even own mortgage-backed securities, but letting them all roll off, so you have a world where the mortgage spread, the difference between the 30-year mortgage and the 10-year treasury, that was 1.5%, 1% for a long time. Now it's 2.5%, 3%. And that's different. So we could have a 4.5% 10-year treasury and a 5.5% or a 6% 30-year mortgage. Instead, we have a 4.5% 10-year treasury and a 6.5%, 7% 30-year mortgage.
Yeah.
And, 0.5% on that 30-year mortgage would provide a lot of relief for that housing market right now. So anyway, now we can see that rate cuts are coming. Trump, he's a real estate developer. He knows what interest rates do to the real estate market. He wants a booming economy under him. Long-term consequences be damned. I've got my Austrian economics, bona fides, and I don't want the low interest rates to cause malinvestment in the future. Trump doesn't care about that. He's a real estate guy. He wants it to boom. So if you're looking at the company Opendoor, and they have almost no competition to sit in the middle of this market and just be the network that captures that market, to be the Uber, not of taxis, but of houses, right? To have that would be a several $100 billion company. I think they're trading at about $2 billion now.
Yeah, that's
And the big obstacle was, so they had four founding tech founders. And, when times got tough, some of them had falling outs with each other. Some of them had personality conflicts, but one by one, they all left Opendoor, and they left it in the hands of professional management, which, sometimes professional management is good. Professional management always has that incentive alignment problem. They always have the principal agent conflict. But take a company like Hudbay Minerals. The CEO is a professional manager. He's not a capitalist. He doesn't own much of the stock, but he does it well. He takes pride in his job. He does a good job. That's very rare in corporate America. Usually the professional employee management is going to, screw over the shareholder every chance they get, or at least it feels that way. They left it in the hands of someone. She had a private equity background. I mean, I don't want to, there's a lot of trash talk on the internet. I don't really have anything bad to say about her, except she's not a rapidly iterating tech founder. And she just announced she's stepping down this morning. So the original founders of Opendoor that still own between them about give or take 8% of the company, And then there's a bunch of people that were involved with it that still own 4% here or there. I think and also they admitted this on Twitter, which I think is amazing because normally all this stuff requires disclosures to the SEC. But some of the original founders on Twitter are saying, it's in progress. We're going to take this company back and we're going to do something with it. And I'm like, how can you disclose that on social media? Like you're supposed to have to file that to the Securities and Exchange Commission. But I think we live in this world where venture capital is the new oligarchy. And now that they supported Trump and they got the White House, venture capital is going to be kind of untouchable and do whatever they want, which is interesting. I'm not really trying to come down hard one way or the other or dunk on anybody. But you have one of the original four founders of Opendoor saying, yeah, we're going to axe the CEO. And like 2 days later, she steps down. So things are happening behind the scenes. The market potential here with the macro tailwinds from falling interest rates to be the possible winner take all network good of that market is a multiple $100 billion opportunity. I wrote about this in June of last year, and I said, look, all it would take is 18% market share and 2 times price to sales, and the company's $1 trillion company. Like that's nothing. Like that's crazy.
Mm-hmm.
Those numbers I might be misremembering, but the write-up was originally behind a paywall, and I took the paywall off and I shared it. So if you find me on Substack and you search for just the ticker symbol OPEN, you can find it from last year. But yeah, things are happening. So I wouldn't call it a meme stock in the same
Okay.
way that because GameStop didn't
I mean,
have.
I know you're not writing about memes, but you get sometimes some of these companies, they driving the price of the stock like just at astronomical levels, and you're just like, okay, is this meme status or what?
Well, I like GameStop. I've written about GameStop and I own a little bit. And I like activist investors. Ryan Cohen's an activist investor, but he is being very patient. Like he's working on stuff, but he's being very patient. But I do like GameStop. But GameStop was really a retail moment. This has, Kozla Ventures. This has SoftBank. This has huge, massive professional venture capital, and that's a whole different ball game.
Mhm.
Carvana, because my biggest mistake, I bought 4,000 shares of Carvana at $3.92 on the day that CarMax missed earnings, and uh, I sold calls on it at $5.50 because I was just a massive idiot. But I had a job at the time, a full time. I wasn't the Unemployed Value Degen yet, and I didn't really have the headspace to think about trades and position sizes. I wanted to do fundamental research. And I was like, this company is undervalued. They're not going bankrupt. They have $2 billion of unencumbered land, and any
Mhm.
bank would write them a mortgage on that. They have access to $2 billion of liquidity, which at their current burn rate is a 5-year runway. Like they have a 5-year runway to land the plane, and it's priced for bankruptcy. So at $3.92, I bought 4,000 shares, but they didn't have big professional venture capital support. It was a father and son team. That father and son team. So if you listen to Ernie Garcia III on earnings call, like that dude is a genius. Like maybe like 160 IQ and snorting 2 lines of cocaine or something. But that dude's brain is firing so fast. Like I was once my first time in college, I was going for a chemical engineering degree. So I took all the calculuses and my federal work study job for 5.15 an hour as I was tutoring calculus, all week. And the kind of math that was needed for him to explain how he was going to shore up the ship, talking about the inventory turnover, like he was rapid firing calculus, which I've noticed how much my brain has slowed down since I hit 40, and that is impressive. So,
Mhm.
Ernie Garcia III he's not part of Silicon Valley Mafia, but he's a rapidly iterating tech founder with a 160 IQ. Now you take Opendoor, and so you're getting like the professional venture capital groups are coming in. They're going to pump this thing up. I don't think there's much in the marketplace I would want to buy more right now on the announcement that the CEO stepped down. Like this is a huge opportunity, and they could fail. It could still go bankrupt. Maybe they never overcome this adverse selection problem that the seller knows more than the buyer. Maybe the next time house prices fall, they lose another $1 billion and go bankrupt. But if this thing has a 20% chance of being a $1 trillion company and you can buy it when it's a $2 billion company, well, you got to do that. You got to get a little allocation of that because that's just insane.
Yeah.
And that's what I wrote a year ago, and now it finally happened. So I was early, but that's exciting. And I still don't know how they can get away with, well, I do know that venture capital supported Trump and now he's in power. So they're not going to do anything about them. But I just find it amazing that you have people that own huge chunks of the company, openly coordinating on Twitter about what they're going to do, saying we're going to replace the CEO, we're going to do this, we're going to do that. Like this is all stuff that people would say, oh, you're not allowed to do it because of, regulation FD, reg full disclosure. And you got to file this with the SEC and you got to do that. Like I'm just amazed at how amazing Twitter is when people who are billionaires will respond to your tweets and retweet you and like your tweets. I've got a couple of
Hmm.
those. I was commenting on, um, there was somebody posting, oh, Opendoor should acquire these real estate brokers. And I was like, nope, you don't need it. All you need are some tech bros in there to iterate quickly and solve problems fast. And one of the four original co-founders of Opendoor, I don't think he retweeted. I think he just liked it. But anyway, it's pretty interesting to see, that kind of interaction because this is a totally new frontier. Like if this was, the 1890 and I had an opinion on what John D. Rockefeller was doing, I would never communicate with him, right? That's just not something that would happen. But yeah, it's just a crazy time.
Yeah, yeah, for sure. Open Door Technologies. All right, you all be sure to check it out. Be sure to go subscribe to the Substack, Unemployed Value Degen, providing value. I mean, you were quoting that stock at what, 50 cents?
Um,
I'm kind of mad at I'm buying it at $3 and I'm like, man, this thing's been on this freaking Substack for a year at 50 cents.
it's worse than that. I think I wrote about it. It was $5. It went down to 50 cents. So, and
Oh,
that's
okay.
sometimes when you're early, you got to ride it on the way down.
Yeah,
But I loaded up,
you
I
could have
loaded up
lost
my
a
boat.
shirt or two. Right.
Yeah. So when I first saw that like the eye of Sauron was gazing on this thing and it was getting real attention, I reloaded up the truck. So I think my cost basis is somewhere around $1.50 right now. So because I saw that it was getting attention and all it needed was attention, right? Because the market position is real. I didn't know if they were actually gonna, take seats on the board of directors or change management. But this morning the CEO stepped down and there's a lot of people saying awful things about her online, and that's just really uncalled for. She's, as far as professional managers go, she's not terrible. I've seen some scoundrels who loot the company and pad their golden parachute and jump out the window. And she wasn't that.
Yeah.
But so just total aside, Hudbay Minerals has a professional CEO who's not a capitalist, doesn't know much of the company, and he is doing a very good job. So there are some consummate professionals out there. It's just they're so few and far between. And usually if they're not insider buying, if they don't own a stake, I just get turned off fast because I've been looted so many times by these professionals.
Yeah, yeah, for sure. Yeah, you definitely got to do your due diligence on the leadership team there. So yeah, I see why you spend a lot of time like breaking down like okay the shareholder or how many shares are they buying and such. And so hey, I'm on the call. Okay, all right, cool. So my daughter, she's just coming in, just
Very cute. How
trying
old
to
is she?
7 years old, 7 years
Okay.
old. So yeah,
I got
she.
a 6-year-old at home and she's a handful. Although just in the last 6 months, she's matured so much that she kind of went from like, Jesus, she ever going to outgrow being, all these tantrums and stuff. And like over the course of 6 months, I'm like, oh God, I can see how she's going to be as a teenager and I'm terrified.
Yeah, yeah, you definitely get a glimpse into that for sure. Yeah, for sure. Yeah, she's getting just getting older, getting more smarter, like figuring things out quicker and everything. So you're just like, okay, I can't wait till you can start cooking for yourself. So then I can just sit on the couch and watch movies. Okay. Like that's the day I'm waiting
Uh,
on, right? I'm trying to watch 80s and 90s movies. That's all I want to watch right now.
yeah.
Uh, so I actually went and bought a 1990s movie the other day. It was my favorite movie growing up, and I'm like, I hope this movie isn't trash. And when I go back and look at it, you know,
Some of them don't age well. What movie was it?
it's a movie called Drop Zone with Wesley Snipes about skydiving crimes and
Oh,
yeah,
okay.
fighting and stuff. And so yeah, it's yeah, we'll see how well it aged here
Yeah.
soon. But Yeah, so let's touch on a couple of uh the equities. So I'm just looking at some of the charts now. I mean, obviously we had discussed before Centrus Energy. This is the gold chart right here. So I'm just kind of doing a little TA trying to see what's gold gonna do next. But just looking at Centrus,
So they
obviously,
just did a $700 million equity raise because I mean, when your stock price goes from 40 bucks to 240, you kind of have to.
yeah.
And also it was coming because they need money to build out their centrifuges. But I
Mhm.
still can't believe the just the speed of that inflection. Just the nuclear narrative went just crazy, go nuts. And
Yeah, I was buying them down here on Liberation Day. I went in
yeah,
accumulating, but then I think I sold right around here, this resistance level, and
triple top. Yeah.
and it shot straight through. I'm like, dang.
There's a technician, I forget his name, but his one of his favorite quotes is "There's no such thing as a triple top." So he ended up being right with this one because it blew right through it.
Yeah,
Um,
yeah, it sure did. I'm like, dang. Yeah. I mean, but if we look at like there's some of the other companies you mentioned, like American Eagle, and you're just seeing like this clear, it hits this resistance around 20 something dollars, falls down. Its resistance, 20 something dollars, falls down. But this one, like, I mean, this is obviously different because then you're getting government backing and such, and it just does something different. Like whenever the US government gets involved with some of these contracts and stuff, like even MP materials, let's look at MP materials,
yeah,
like whenever the government gets involved, it just these things just skyrocket, and it's hard to tell like which one. Well, I can't say it's hard to tell. Some of them like have a special niche, and then some of them are like you're like, okay, it could be this one or that one. Because I saw recently with Oklo, um, I was in Oklo a while ago, around here, around $5, and then I did not
mhm,
hold that whole time, but it's sitting over above $70 right now. And I was also in like nano nuclear, which I bought them at around not 8, $9. But it's like, okay, well, they're two different companies, but who knows which one the government's gonna cut a deal with, it's hard
yeah.
to tell.
Well, my thesis on Centrus Energy. So I even found the government report where they were going through, okay, who are we going to choose for our nuclear enrichment? And they went through all the different possible technologies that scientists have ever come up with for enriching uranium. And it was kind of in the government's own report that they were going to go, primarily with Centrus Energy because that technology is the most proven over time. And other people can do it. So one of their competitors, they're becoming a new competitor. So BWXT is the nuclear spinoff of Babcock and Wilcox, BW. So BWXT, they were the ones who would buy the enriched uranium and and shape it into fuel rods. And now they want to expand into enriching it as well. And so BWXT is going crazy too.
Uh,
But I encountered them because I found this company BW, which was the parent before the spinoff. Yeah, so BWXT, they're the ones that shape it into fuel rods, the enriched uranium.
hmm
But they bid for some of the Department of Energy contracts, grants to start enriching uranium. So they're going to compete with Centrus Energy, and they're they have their own cash flow to draw from. Um, but after the chart does that, it's just so painful to buy. But if you look
Yeah,
at BW, I wrote about this one a while back. It's called Babcock and Wilcox.
yeah, I remember seeing that one.
Yeah, and so that's the parent company that spun off BWXT. Now they're this 170-year-old company that has their original steam boiler company. And if it really is true that we need every every watt of energy we can possibly scrape together for these data centers, and nuclear takes years. And if you look at the natural gas power plants, so natural gas power plants, they don't use steam boilers the same way coal power plants do. They use like a jet engine turned vertically. So like if you're in a plane, you see the jet engine. A natural gas plant has a great big one of those inside. and those are manufactured by Siemens or GE Vernova or I think Mitsubishi. Well, the backlog for those now is 5 years out. You want to order a new natural gas power plant. They say, okay, the turbines will be 5 years away. You can burn natural gas on an old steam boiler and make electricity. It's just a bit less efficient. So there's a lot of coal plants that were shut down and they can be converted to natural gas. So if we really need every bit of energy we can scrape together to do AI and to counter China, and the demand is just going to be crazy. Babcock and Wilcox recently won a $200 million contract to convert a coal plant to a natural gas plant. And so along with Siemens, Babcock and Wilcox has the engineering qualifications to do these coal to natural gas power plant conversions because they have all these original patents. They have this expertise on these old steam boilers. So this is kind of a real sleeper in the artificial intelligence data center build out beneficiaries because getting new nuclear online it's not going to happen within 5 years. So if you need all that power now, and the natural gas turbines you're not going to get within 5 years, and you need all that power now, then one of the only ways to get all that power now is either to restart a shutdown coal plant and burn coal, or to convert a shutdown coal plant and burn natural gas. And in either of those cases, these guys they can bid and they can win that business. So this is kind of a sleeper, and it's just started waking up from $1 a share to $1.50 a share, but it hasn't really gone crazy and broken out yet. It's still cheap,
Yeah,
but
yeah.
they are struggling. They do have a debt burden. They recently did a tender offer to try and buy back some of their outstanding debt at a discount. But this company, they sold a European subsidiary for as much as their whole market cap. It was just, whenever they were short on cash, they would sell a subsidiary and raise $40 million, $120 million. And that's really shored up their balance sheet. So, yeah, it wouldn't take, and parts and service revenues grew 37% last year, over this last year over year. So the the energy demand and the parts and services they do to maintain all these electricity steam boilers is now ramping up because of the artificial intelligence revolution. So this is kind of a sleeper out there
Yeah,
for
yeah, that's good.
AI
You're getting
data
into the
center.
weeds, man. You're getting into the weeds of this. Like you're getting into like the nitty-gritty details of like, okay, for this, because oftentimes we just see the headlines, uh Microsoft signs a deal with, whoever, and then, that stock goes up. But then it's like layers to this.
Yeah, well, if I'm late to the party, I gotta because I'm not usually so fast that I can react as fast as these algorithms do. So if I'm late to the party, I gotta drill down and say, okay, well, who's their supplier? How is their business going to be? Another one like that is I think we talked about it before, but Custom Truck One Source. That symbol is CTOS.
Yeah, CTOS. Yep.
And they're the ones that have the trucks. They have a rental fleet, and they sell the trucks like that the linemen use. So if you need a truck with the boom on it and the drill to put in telephone poles and stuff like that, this is the company that has a rental fleet of that stuff, and they assemble those. And their last earnings call, they're like, so most small caps, most industrials are saying, with these tariffs, there's uncertainty. We can't predict. We'll give you guidance 6 months from now, but we just there's too much uncertainty right now. Custom Truck One Source was like, nope, a 22% growth year over year. We have demand as far as the eye can see. The grid needs work, and nothing is stopping this train. Choo choo, let's go. It's
Hmm.
there's zero concerns about uncertainty. Their future, as far as they can see it, is certain. The grid needs expansion. The grid needs repair. The artificial intelligence data center build out is going to benefit them.
Yeah. I saw them. I saw the company because I owned the shares of these. I read your report on them, and ended up buying some shares. And I saw the stock pop when there was some news about Google investing into power grids. I don't know if that was related or what, could have been something else, but when I saw that big headline about Google and power grids, I saw custom truck one source start to pop. So I was thinking about that. It's like, okay, Google's investing billions of dollars. They're committing billions of dollars into these power grids, and this is a company that could benefit from that.
Yeah, one aspect of the data centers is you can't, so the sensitive equipment, they can't handle the power disruptions. You can't have brownouts. You can't have, old power lines taking this data. You've got to build out some new capacity for that because they need stability. You can't have, rolling brownouts on your, data center the size of Manhattan. It's just not tolerable. So, and also you have the electricity demand from reshoring. So our electricity demand was flat for 15 years while we shut down all this manufacturing. Now that we're trying to bring back some of that manufacturing, well, the people in Texas aren't going to have smaller houses or change the temperature on their air conditioner, right? The electricity demand residentially is not going away. And politically, the cost of electricity is going to be a big deal. So you already see some, I think it was New Jersey, there was a news article, the electricity cost for homeowners doubled. And that's enough for people to go to the polls and they're going to say, okay, we need price discrimination. We need different prices for data centers and for residents. This is going to be a huge political topic, is the electricity bills that homeowners face from all this increased demand. And then just how much
Yeah,
supply can we get online? And if the only, so that gets back to custom truck one source for the grid and Babcock and Wilcox, potentially for the steam boilers. But Babcock and Wilcox has some debt. They've been struggling for 5 years. It's not for the faint of heart. Custom truck one source is in a much more, stable position.
so what does this mean for like utility companies? I know some of the utility companies have already been running. I've been having my eye on Southwestern Energy for a while. It's fun. I'm actually spelling their name wrong. South.
It's going to be case by case for the utilities because some of the utilities are telling the data centers, we could we could serve you 3 years from now. And the data centers are like, well, that's not cool because we need it right now. So it's going to depend on how fast the utilities can respond and whether or not they're willing to expand capacity for them. And you also have the local municipalities voting it down, say, we don't want a data center near us. So they'll veto the project. So you're going to see data centers building, close to natural gas supplies and
They
maybe
stock
building
up.
out or contracting their own power gen, things like that. Maybe just in the interim until the grid is going to be able to take them. So it's going to depend on utilities are not known for moving quickly. And part of that's the regulatory burden and part of it's just, stodgy bureaucratic monopolies. Um, but the utilities are going to be case by case and they're already so expensive. I'm such a value degen. I have a hard time buying expensive things.
Yeah.
But they pay a dividend, which is nice. But it's going to be, I want to say the data center, the utility that's in the Virginia data center corridor is expanding aggressively. I forget which one that is. But it's going to be case by case whether they're going to rise to meet the demand or not.
Yeah. Yeah, definitely. Yeah, that ticker I was looking for, it disappeared. I'm like, this company probably done went bankrupt or something. So let's get over to Portillos, man.
Yeah.
I was looking on their site, because I had watched your I had read your articles on them for a while and have been a shareholder and such. And I was like, man, it's in Chicago. They got a couple locations, other places. There's not one in Washington State. And then I found that you can actually order from them and they can ship to you. So I don't
Oh,
know if it's
wow.
as good, but
Yeah, there's
I kind
there's going to be some quality loss there, but that's how fanatic their fans are. Like they get this hankering, like I need that Italian beef sandwich, and they're willing to pay to have it shipped to them. So I came across this name when I was a college professor. I was not smart enough to swap phone numbers with like 100 of my best students, but I swapped phone numbers with three or four of them. And one of my students, he was probably the most ambitious student. He finished his college degree in like 2 years, and he moved to Chicago because his girlfriend was doing her master's there. And he this is somebody that like he was so ambitious. It pretty much never had a casual conversation with him. It was always business. He texted me out of the blue and was like, hey, you have to try Portillos. And I was like, have you been hacked? What's going on here? He's like, no, 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 this is a really cool place, you got to try it. And so I forgot about it for a couple months and finally looked into it. And when I looked into it, there's this concept in these in brands called Net Promoter Score, which is, how likely are you to recommend this to somebody? And I think that's important because I followed a lot of companies that were DTC, direct to consumer, and the end result was always, unless you were razors and razor blades, unless you could do a subscription, the end result was always the same, and that was Google and Meta and all the advertising companies. They just take all your money, right? It's so expensive to reach people. Traditional marketing is just a huge money pit, and that's why these major corporations, the Mag 7, that's why so many of them just have huge, massive cash flows, is because they're these gatekeepers to advertising. But if you have a fan base that's so fanatical, I don't know if it was a Steve Jobs quote, turn your customer into an ambassador. If you have people who are so fanatic about your product that they're texting their old college professors saying, you've got to try Portillos, that's shocking. And you look up this concept called Net Promoter Score, and depending on which year you do it and who the surveyor is, there are some fanatic brands like In-N-Out Burger and Chick-fil-A, and Portillo's ranks higher than In-N-Out Burger and Chick-fil-A. It's like we're talking number one, highest possible Net Promoter Score. And the Net Promoter Score is just a one question, would you recommend this to somebody? But what's different is about Portillo's is I've had people reach out to me and say, you've got to try this. So it's not like, would you recommend this to somebody? Their customers are recommending this to somebody. So now the other aspect about Portillo's is just where they are in the restaurant framework. A lot of fast food is going too expensive. They say, okay, we'll raise prices. Like Subway got bought out by private equity, then their $7 sandwich becomes a $13 sandwich. And like, what are you doing, Subway? Like, it's not even good. Like, what are you trying to charge $13 for cold deli meat? Like, what are you doing?
Especially after that Jared Fogle thing, man. You just like,
Yeah.
yeah, bro.
Yeah, well, so that is unrelated. I was surprised. So Abercrombie and Fitch is making a big comeback, and so I wrote about American Eagle and Abercrombie and Fitch side to side, and like they were molesting their models. The CEO was like that's you'd think that would
Damn.
be kind of a turnoff, but what's strange is Abercrombie and Fitch is following their demographic as they age. So now they're selling clothes to like 45-year-olds, whereas American Eagle is still advertising to the high schoolers. So, American Eagle is staying with marketing to young people, and Abercrombie and Fitch is just following their old cohort as they age. So 20 years from now, Abercrombie and Fitch is going to be selling clothes to 60-year-olds, which is it's just a bizarre choice for them to go to. Anyway, totally unrelated. So Portillo's has this brand fanaticism, and then their place in the restaurant value chain. So they have the highest cost of ingredients of any of their competitors. So if you're looking at, if you buy a McDonald's cheeseburger, how much it actually costs them to make it, Portillo's has the highest cost of ingredients. I think it's right now it's about 31% of the bill went to the food itself. And when you eat there, so there is one in Tampa, I went there. When you eat there, you can tell, like it is real food. One of their flagship items is the hot Italian beef sandwich. AI didn't do a great job making it, but it's delicious, right? It's real. Like when you eat a McDonald's hamburger, like, okay, this has additives, this has fillers, this isn't like real beef. The hot Italian beef sandwich at Portillo's, it's real, and you can tell the difference. And then the pricing is they don't try and crush people, right? The pricing is they try to go for everyday value. They don't do a lot of sales, they don't do any promotions, but the everyday value is really good. And then the way they try to overcome having, the highest cost of ingredients and not overcharging is they try and make it up with volume. So what really caught my attention is, and the statistic I had seen, so I had read this in the news, I don't know how many years ago, that Chick-fil-A was this market leader in volume. And I have this chart. So this is now maybe 2023 data. So this is a year and a half old. But the average McDonald's does about 3.9 million in annual revenue. The average In-N-Out burger does about 5.3 million in annual revenue. The average Chick-fil-A does about 7.5 million annual revenue. So you've seen how busy Chick-fil-A is. You've seen their car line like shut down streets as people are waiting in line, and then they're also famous for how efficient their car line goes. And have you ever eaten in a Chick-fil-A on like a Saturday afternoon and it's just like crazy in there? So Chick-fil-A 7.5 million annual revenue. Portillos, one average location, 2023, 9.1 million annual revenue. So Portillos, they make it up with volume. They beat out Chick-fil-A into how many people they get going through their locations. It's absolutely insane. And
Wow.
there's a bifurcation there because their new stores, the newly open stores are doing 6 million annual revenue, and their Chicago stores are doing over 10 million in annual revenue. So you're talking about one location doing 2.5 times the volume of a McDonald's, doing twice the volume of an In-N-Out burger, beating Chick-fil-A by another third above what Chick-fil-A does per location. Like this is insane volumes. And one of the reasons they do it is so they the food, their strategy is the food should be indulgent. It tastes good. It makes you crave it. You want to go back again. And the menu is also to have something for everyone. So they have hamburgers. They have Chicago hot dogs. They have the hot Italian beef sandwich. They have salads. So the average location does $600,000 of salads in a year. That's I think Sweetgreens only does like 2 million in salads a year. So you're talking about 600,000 in salad revenues a year. They've got milkshakes. They've got and it's fast food, so there's no tip, and they're strenuous. They're not going to have it. The kiosk is not going to ask you to pay a tip. It's no tipping, right? They want it to be everyday value, but they also serve beer, right? So you
Mm.
can go, and unlike McDonald's, which when I was a kid was decorated, and now it's just like this soulless gray box for sad adults.
Yeah, yeah, it definitely does not that appealing,
Yeah.
I miss the freaking slide and everything they had in there.
So
McDonald's used to be tight, y'all.
yeah. Oh, I love the playground. It was like a burger prison. You'd climb up inside this burger
Yeah.
prison with like bars on it. That was my favorite. Um, but Portillo's has stuff on the walls. Like they decorate it like an Applebee's. So you could go to an Applebee's or a Chili's and you could have a waitress and you could have to tip and you could pay $40 for two people. Or you could go to Portillo's and, okay, you bus yourself, you buy your own stuff, you sit at the table, but there's atmosphere, there's stuff on the wall, and there's no tipping. So if you look at the average customer receipt, Chick-fil-A is like $15 a person. The average receipt from Chipotle, $18. But to be fair, the portions have been historically large enough, so some people are getting two meals out of them. I'm not, but what I hear in social media is people go to Chipotle because they have leftovers. I'm 6'4". I weigh 280. I can eat a whole burrito and the chips too. But some people get two meals out of it for $18. Portillo's, the average ticket size isn't one person, it's two people. And it's $22 for two people. So you're talking about people spending $11 a person and they're getting social interaction. Whereas like you see the line at Chipotle, everybody's ordering one burrito for themselves. It's kind
Yeah.
of sad. You go to Portillo's, people are going on dates, people are bringing their families, there's social interaction, there's atmosphere. They're spending $11 a person and they're getting more cost of ingredients for the food. They're getting better food and real food. Um, and they make it up in volume. So those Chicago locations that do $10 million a year have higher profit margins than Chipotle because Chipotle's out there. I don't have it on my list, but Chipotle's out there doing, I think it's closer to, $4 or $5 million a year in revenue, less than Chick-fil-A. So you cover your fixed costs, you make it up on volume, you give real ingredients, real food. Having something for everyone, you get this large menu, but having large volumes, you don't have the spoilage because you're always moving that stuff through quickly. So to me, I think it's what fast food should be. Like I'm so behind this concept. And when the founder sold it to private equity, the founder sold the company to private equity for $1 billion. It wasn't the highest offer. He sold it to a private equity firm that promised to honor the market position. And so far they've been doing that they want to keep the prices low, the ingredient cost percentage high, the quality high, keep the volumes high. I think the big I think there's a couple of reasons why this stock hasn't caught on. It hasn't had the huge multiple re-rating, and I think it will have this huge multiple re-rating. So the private equity firm that bought it for $1 billion when they had 40 locations, now they have, I think, 84, 86 locations. So it's double the size. And they're opening 12 locations in the next 6 months. So they're targeting about a 12% store location growth rate. So one location costs about $5 million. If they can get upwards, so I think the new locations don't get the 10 million Chicago revenue. It takes time to do that. So call it, they open up, they get 8 million in revenue. They have a 25% profit margin, so you make about $2 million off of it a year. The store pays itself off in 2.5 years. That is a really high return on cash. So they're opening 12 stores in the next 6 months. I think there's 3 reasons why the stock price is depressed. One is the original private equity firm that bought out the founder. They had private units that they've been selling in the market. So if you just look at the share count, it looks like they're diluting, but they are not diluting. So they are not issuing stock to do the store count. They're growing by cash flow and they're growing by debt. Right. So
these like warrants or something that they got? Like,
no, it's just private LLC units that convert into common stock when they sell them.
Okay,
but it just confuses the share count metric. And if you just look at it without digging in deep, it looks like dilution, but they are not diluting. The other reason is, I think if you look at something like Peloton, one of the reasons it got such high multiples is because they sold to people that worked in finance. So like if you're doing a podcast now and somebody's living in Manhattan and you see their bedroom, you've got now a Peloton covered in coat hangers and shirts that they're not using anymore. But a huge percentage of their sales was to people that worked in finance, worked in Wall Street. Portillos hasn't opened in Manhattan yet. So I think part of the reason that you don't have this huge multiple expansion that you see in Chipotle and Cava and Sweetgreen and stuff like that is just, I think Wall Street's sleeping on this one. And I think the reason is they believe, and I think this is wrong, that this is a Chicago phenomenon and it can't expand outside of Chicago. And 2 things about that. So when I was in the PhD program, they had, just as a basic foundation, we had all the MBA classes. I had a really good, so, a state school, you get lucky or you don't get lucky. I had a really good marketing professor. He was the guy who launched the first interracial advertisement on television for Procter & Gamble in the 70s. He was doing focus groups. He, had people sit down, like, are you comfortable with this? And in the 70s, the feedback was they were not comfortable with like an interracial romantic couple, but they were comfortable with like interracial coworkers. So he put together like the first interracial television commercial for Procter & Gamble. It was like 2 construction workers sitting down eating their lunch, a black guy and a white guy. So anyway, the dude was a dinosaur. He was so knowledgeable. Chicago has always been one of the most important test markets because of its demographics. You have Hispanic, you have white, you have black, you have everybody. And it has always been the case that if it works in Chicago, it can work nationwide. So that should be the default understanding. But there's this narrative that it can't work outside of Chicago, which I think is crazy. And then to put this can't work outside of Chicago thing to rest, they opened their first location in Dallas. And so again, keep in mind, like that busy Chick-fil-A you've been in that is absolutely nuts and packed, hard to find a seat, and the car line is going around the block and blocking traffic. That does $7.5 million in annual revenue. Their first Dallas location did $17 million in its first year. Right? That's 2.5 Chick-fil-A's. Right? The management comment on it said it almost broke the store to have that kind of volume there. It was insane. So they immediately opened, I think it was 3, 4, or 5 more in the Dallas area to try and siphon off that traffic, because 17 million at one location was too much. It was crazy. Now, some people say, well, this location was close to Nebraska Furniture Mart. It's kind of an attraction area. Like Crystals in that location would not do $17 million of volume. Sweetgreens would not do $17 million of volume if it was next to Nebraska Furniture Mart. Like $17 million of volume, doing 2.5 times a Chick-fil-A's volume is absolutely insane. So the idea that this is Chicago only, I think, has got to be put to rest. But in the data, their chief marketing officer got poached last year. So their chief marketing officer got hired to be the CEO of Giordano's Pizza. So The rollout of their first Dallas location was good. They had a chief marketing officer. The rollout of the rest of their Texas locations has not been good. And by not good, I don't mean like they're losing money. I mean, they're not doing $10 million of revenue a year like a Chicago location. They're doing closer to $6 million of revenue a year without a chief marketing officer marketing it the right way. So the market reaction now is like, oh, these are failures. They're not going to do good outside of Texas. Wait until they have a new chief marketing officer and they actually advertise properly. Wait until people try the food. There's another piece of data that it can do well outside of Chicago, which is about 10 years ago. I don't know why, but 10 years ago, they expanded in Arizona. I think there were a lot of Chicago transplants and they were just begging for a Portillos. They now have 4 locations in Arizona. Those Arizona locations are comparable to the Chicago locations because the market there got 10 years of learning like, wow, this food is really good. So you either have to have a chief marketing officer that's marketing, or you need time for the market to learn how good the stuff is. But if it takes a few years to go from like $6 million per location, which is better than In-N-Out Burger when they first opened, to doing $10 million a location, which is absurd and crazy. Okay, it takes time for the market to learn how good hot Italian beef sandwiches are. But I think when they get a new chief marketing officer, you're going to see something very different happen with Portillo's. And another thing, in March, they started a membership rewards program. They haven't done anything with it yet because they don't have a chief marketing officer. They just got people to start signing up for it. And this is a company with 80 locations, not 4,000 locations, 80 locations. They had 1.9 million people sign up for their rewards program. So McDonald's has about 3,000 people per location in their rewards program. Chipotle has about, I think, 5,800 people per location in their rewards program. Just since March, just in 5 months, Portillo's has 20,000 people per location in their rewards program. Like, that is mind-bogglingly insane.
It is. That is.
The fanaticism of the Portillo's customers, once they get the everyday value and the indulgent food and they get hooked on it, this is unstoppable fanaticism. And when you see a new chief marketing officer get hired and they have access to a rewards program with 20,000 rewards members per location, and they put out like, hey, free small fry if you come in on Tuesday afternoon. Like, if they start doing stuff like that, it is going to absolutely knock everybody's socks off. Like this, I can't pound the table hard enough. We're in a market environment where companies sell off aggressively on earnings. And I put a write-up, it's paywalled on my Substack, because I was breaking down all the things last earnings. Portillo's sold off hard on its most recent earnings. And I think it was totally unnecessary. I think it was totally oversold. The company was bought by private equity for $1 billion when they had 40 locations. Now you can buy it for $500 million while they have 80 locations and they're opening 12 more. So you're buying this company for a fourth of the price that private equity bought it for originally. Like, it's just incredible value. And this company,
what's the valuation looking like now? Like price to book, what are margins looking like and everything?
So it's a growth stock, which is hard for me because I'm a value investor. But every once in a while, I try and put a value on the growth multiple. And it's hard for a value investor to do, but I do it. I've got price to sales of 0.79. A growth stock, that could easily be a price to sales of 2, 3, 4, 5. I think Chipotle has a price to sales of 5 or 7. And a lot of these companies, like, once you have a couple thousand locations, like your 3,000th location is not in a booming metropolitan area, right? You've got a low-hanging fruit problem where they open the best locations first, and then they get worse and worse and worse over time. So the growth is going to slow down when you start opening in like Dumfries, Georgia, or places like that. Like, there's just not as huge population centers. So price to sales of 0.79. Price to book is difficult because when you have an old company, you have locations. Some locations in Chicago, they own the real estate because the founder was doing it old school. So you're going to have the problem where book value has the cost basis and not the current value. So price to book is 1.2. And then price to earnings. So this is another one, is when you have huge CapEx. So Portillos is spending $100 million this year on growth capex for the 12 locations they're opening, and then so it's the 2025 cohort of growth locations and the 2026. So they got to start building out the 2026 cohort. So they're spending $100 million in growth capex this year, and that destroys price to earnings ratio. So you can't really make good sense of price to earnings that way. So I would do price to sales 0.79, market cap 575 million,
Mhm.
1/4 of the price per location that private equity bought it at when they were 40 locations. And again, the company has problems, right? The Houston or Austin, but the Texas rollout has not been what people hoped it would be. Two things about that. One is, again, chief marketing officer got poached. They're still trying to replace him. I think that's a big deal. Some people on Twitter say that I'm just being, I'm being ridiculous about this thing. They're also they're and I mentioned about this with Opendoor. You want in a growth company, you want rapid iterations. You want them to experiment. You want them to figure things out. So they've been experimenting. They've been experimenting with, can we make the locations 1,000 square feet smaller? Can we have a location? So they're doing one in Florida with no drive-through. It's in like a walkable downtown area. So they're iterating rapidly. In the Houston, can't remember if it's Houston or Austin rollout, they tried a restricted menu. And what they found is going from 8 salads to 3 was a win-win-win, right? There's less spoilage, the staff needs less training, the customers are happy with 3 salads instead of 8. But they also tried no beer. And they're like, okay, that was a mistake because people like beer. They want to have, you're going to have a burger, people want to have a beer with it. And that's kind of a big differentiator between them and McDonald's. Especially now that nobody has kids in the playground at McDonald's anymore. What are they doing? Why do they not have beer with their burger? If you're going to have a bunch of sad adults in there. But anyway, so again, they're experimenting. Some of those experiments come out negative. They're experimenting with breakfast in Chicago. Keep in mind, $10 million of revenue per location. They're not even doing breakfasts. So they
Mhm.
created a breakfast menu, make some egg sandwiches and stuff like that. And it's going very well, but they're waiting for feedback like, is this going to burn out our restaurant managers to have too much volume, right? Because that's the concern. If you're doing more business than Chick-fil-A, they're worried, okay, breakfast in Chicago is going well, but are we going to burn out our staff this way? Do we need to not do breakfast because it'll hurt us in the end? So, or, is breakfast going to work in Chicago and not work in other locations? So they're experimenting. And my interpretation is that the C-suite executives, they're experimenting smartly, they're taking the feedback, and they're doing the things that you want a growth company to do. You don't want them to build out 500 locations, but then like, oh, they could have done it better, they could have tweaked it, they could have gotten their formula better. So I think the haters on Portillos don't like the experimentation and that, oh, these are mistakes. What are they, idiots to not have beer in the restaurant? Well, yeah, that was a mistake, but going from 8 salads to 3 was a win. So it takes experimentation to figure that stuff out. But yeah,
Yeah.
I just can't bang the table hard enough on this thing. Oh, and after the stock sold off, so I like following insider buying. I want to see that the management team is full of capitalists and not these professional managers that sink the place. When the stock sold off so aggressively on earnings, there was one of the strongest insider buy signals I've ever seen. And insider buying from directors, take it or leave it. I've seen a lot of directors that are wrong about the company. Insider buying by the chief executive officer. So the CEO is a salesman. He's trying to pump up the stock. He's trying to sell the brand. And he becomes a true believer. He smokes his own brand. And that's okay. If you look at, so there's one of my PhD advisors, I think it was Dr. Sutton. She had a paper on this. But if you look at CEOs that are wrong, but they're wrong optimistically. So their predictions, they come in at worst their predictions. Like take Elon Musk. We're going to have full self-driving at the end of the year. We're going to have full self-driving at the end of the year. We're going to have full self-driving at the end. So years it goes on, we're going to have full self-driving this year. And then online people say, oh, he's a fraud. This is, bad stuff. Okay. He really believes it. And by really believing it, CEOs that are systematically wrong optimistically, they get more patents out of their employees per engineer, right? So leadership is about inspiration. So when I see insider buying by the CEO, he can be wrong, but he can be inspiring people. Portillos had insider buying from the chief financial officer and the general counsel. Those are the two people in the C-suite that are pessimistic, risk managing bean counters, right? If they're willing to take $200,000, $300,000 out of their checking account and buy the company's stock, these are people with the most inside information, and they're not drinking the Kool-Aid like the CEO is. So
Yeah.
Portillos had a cluster buy on the earnings sell-off by a director for $1 million, which, yeah, whatever. I've seen directors be wrong with $1 million. That happens. But $300,000 from the chief financial officer and $200,000 from the general counsel, that's the strongest inside buy signal that you can probably get, is the most pessimistic people in the room taking like a year's worth of their salary and sticking it into the company stock. That is, again, this company has this fanatic following and people want to be a part of it. And that's, you want to jump on that train and go where it's going. So
Yeah, for sure. Yeah, so yeah, thanks for sharing that. We got to wrap up and everything. You also be sure to click the link in the description below. Go check out the Unemployed Value Degen Substack. A lot of value there, a lot of value in this conversation as well. And so be sure to go read up on those articles and such. And how much is the subscription per month? Is it still $5, or did you go up a little bit?
I raised my prices at $7 a month now.
Yeah,
So trying
woohoo!
to
You know,
trying to squeeze out a little more.
yeah,
But
yeah.
no, yeah, I think I add a lot of value. I've gotten some things wrong. Everybody does, but I think I add a lot of value.
Yeah, for sure. So you all be sure to go check that out. I'm definitely gonna pick up some more shares of Portillos, especially looking at the chart now. It's like, yeah, they're at a depressing low right now. So this is a good time to buy when there's blood in the streets.
Yeah, it is definitely blood in the streets. I think this is, I backed up the truck. I bought stock. I bought long dated call options. It didn't even go out that far because it's not the most liquid security. But yeah, I backed up the truck. I'm a true believer. There is one in Tampa. I've tried the food, and you can tell that they have the highest cost of ingredients of all their competitors. You can tell that it's real food, and it's affordably priced. And like the volumes are crazy, and it's not just a Chicago thing. So anyway, I've pounded the table hard enough.
All right, cool. Sounds good. All right, you all be sure to go check it out. Steve, always a pleasure having you on. Look forward to having you back.
Thank you very much.